This episode is brought to you by SS&C Mineralware. Are you managing mineral assets and feeling overwhelmed? Unsure if you're getting paid what you're owed? SS&C Mineralware is here to simplify the management of your minerals, royalties, and non-operated working interests. Mineralware's out-of-the-box features give you the tools you need to visualize and keep track of all of your assets in one place. Mineralware lets you know in seconds where your interests are, what's active, what acreage is open for lease, and if you're getting paid what you're owed. With Mineralware, you can even automate your revenue and JIB processing and eliminate tedious manual data entry, allowing you to focus on more pressing issues. Thousands of mineral owners rely on Mineralware to keep their mineral management simple, automatic, and all in one place. Take control of your mineral assets today with SS&C Mineralware. To see a demo, you can visit their website at www.mineralware.com. That's mineralware.com.
Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. And in this episode, we're going to talk about the future of natural gas prices and how increasing our liquid natural gas or LNG exports and the extra demand for AI data centers, how that is reshaping the natural gas market and what it's going to mean for the price of natural gas in the future, and then ultimately what we're going to get paid in royalties is directly impacted by those prices. So we thought this would be good to do a deep dive and talk about, the numbers that they're, throwing around in terms of additional demand for natural gas, how much additional power generation demand there is from these AI data centers, and then break that all down in terms of, what do we see the growth in natural gas demand look like in the future if all of this plays out as they're predicting. So before we hit record, Justin and I were talking about, AI and the different huge projects that are in the works and, the fear in the back of your mind. And I saw this article before we hit record as we were preparing for this that was talking about, will AI achieve general intelligence? You hear this term AGI or artificial general intelligence. In other words, will it become sentient? And what would that mean for the future of the human race? And, in my mind, the fears of, what happened in Terminator and Skynet going live and pushing the button and ending it all for us is a real fear, but then also, it's a reality. And, in fact, I used AI to help prepare the outline for this episode. So it's just very pervasive and into the modern workflow of a lot of people and just in making our lives easier. So pretty interesting developments, even in just the last couple of years that we're talking about this.
You said it, man. So much of this development of these data centers has kind of happened quietly. We knew it was coming to some degree, but it's here. The projects are in progress. And now the big question of how do they power these things is the question that needs to be answered. And Matt, we were talking, probably 6 months, a year ago, 2 years ago, about natural gas prices and what it would be that would make these tick up. We knew it was probably going to be exports, but I don't think that we saw it coming, that there were going to be these contracts going on between operators and data centers to supply this massive amount of power generation. Yeah,
it's really just blown up, in the last couple of years. And, to your point, Justin, I think that we're seeing these off-grid power plants being considered and proposed that would normally supply, hundreds of thousands of homes that are just going to supply these mega data centers that are being built for AI. And there were a couple of interesting presentations. So we had the National Association of Royalty Owners convention in Oklahoma City last week, which was the first week of October. And Justin and I just got back from that, and we were, had really amazing speakers, and two in particular kind of stood out to me. Kyle Reynolds, who's the president of the AAPL, the American Association of Professional Landmen, gave an interesting talk about the demand and talked about AI and some of these mega projects and the size of these projects. And then Jeff Starling, who's the associate, I believe, Secretary of Energy for the state of Oklahoma, talked about increase in demand and, supply and demand and how are we meeting those energy needs, both in Oklahoma and what Oklahoma's piece of the pie is, and then globally. But both of them talked about AI data center demand. And one of the slides that Kyle showed overlaid one of these large data centers that Meta is proposing over the island of Manhattan in New York. And it was basically the size of Manhattan. It was the largest building I think ever proposed. It was going to be some insane number of millions of square feet that just for these AI data centers, so rows and rows of computer servers and graphics cards or GPUs that they're using to compute and to provide these kinds of answers to the queries that you make when you type into ChatGPT, to answer a question that you have, or if you're using whatever flavor of AI that is part of, the operating system you're using, or even on your phone. So pretty interesting that how this has really just developed in the last couple of years.
You said it, Matt. And let's set the stage and get kind of down to the level with natural gas. So natural gas prices hit historic lows in 2024. The Henry Hub averaged just $2.19 per MMBTU, and this represented an all-time low. It was driven by robust production and demand that couldn't keep pace. Prices now have begun to climb in 2025, with the first half averages reaching $3.60 per MMBTU, representing a 67% increase from the previous year. As Matt mentioned, there's a fundamental shift happening right now. The EIA projects that natural gas prices will nearly double between 2024 and 2026, reaching $4.30 per MMBTU. This could mark the end of the era of low gas prices for the foreseeable future, and we'll see exactly how that works out. Matt, the LNG export boom is also something that we've been talking about for a long time, and it was a big part of Trump's administration and his push for this. Talk a little bit about how that plays into this picture.
First of all, the LNG export boom was sort of looked at as the primary driver for the increase in natural gas demand, over the past several years. And in particular, we have export capacity that's on track to more than double between 2024 and 2028. And it's going to grow from about 11.4 billion cubic feet per day to 24.4 billion cubic feet per day. And that's if all of these projects that are proposed and in progress actually come to fruition, and, all of those things. But the International Energy Agency describes this as the largest capacity wave in any comparable period in history of liquefied natural gas markets or natural gas markets, period. So what that means is there's very robust natural gas demand that we see globally. And part of that is because there's a lot of countries that don't have natural gas supply, whether that is self-inflicted, as in the case with the UK, who's banned fracking and banned a lot of the drilling for natural gas and oil. They'd have robust reserves, but they're just refusing to tap into them. And so the US is standing ready to supply that energy need in the form of liquefied natural gas cargo ships that will dock in the US at these terminals, fill up, and then go over to Asia or go over to Europe and supply. They do the opposite on the other end, and they take the liquefied natural gas and they regasify, put it in the pipelines, goes to people's homes, and they have their furnace that turns on, or they have their natural gas stove, and it supplies those things, that existing infrastructure that's there. And one of the things that has really changed, I would say, in the last year, and actually the genesis for this episode came partially from a question that I received from a listener. And the question was, on his first day in office, President Trump signed an executive order to withdraw from the Paris Climate Agreement and instructed the Energy Department to lift the government freeze on new LNG export permit applications. And their question was, how will that affect LNG prices? Does it create bigger markets? Is the LNG ready to be shipped? And then they mentioned the Keystone XL pipeline, which we'll mention at the end, and what that might look like. But, from those questions related to LNG, certainly that had a big impact on the futures prices for natural gas, because ultimately when the market prices in what the price of natural gas is going to be a year from now or 2 years from now, they're trying to project what the demand will be at that period of time. And as a result, trying to match up their models for what supply is going to look like and what demand is. And then ultimately that will dictate what the price is that the market is projecting. And for the most part, pretty consistently, I would say for the last couple of years, if you looked at the NYMEX strip price. That's the basically the futures prices on a monthly basis. If you have a futures contract that is going to, agree to supply or to agree to purchase, what price are you willing to pay in that at that point in the future based on what you think the fundamental, macroeconomic outlook is going to be. And largely that is, pretty much gone upward. If you were to graph it, have prices going upward pretty consistently for the next couple of years, to the $4 plus per MMBTU or per 1,000 cubic feet, which are kind of used somewhat interchangeably. So effectively, like Justin mentioned earlier, we're looking at natural gas prices roughly doubling from where they were last year to around $4 and say 60 cents per MMBTU. And that's, played out pretty consistently if you look at the strip price. And I just pulled it up. And, if you look out a year from now, October of 2025, and the price that they're projecting is around $4.09 per MMBTU. So higher than what it is today. We're around 345 today. So, at least I guess whatever that is, about 20% increase from where we are. So that is good from the standpoint of if you're projecting, wanting to build these plants, right? So you're wanting to lock in prices to supply gas to these LNG export terminals and to drill additional wells. They have to have prices that are going to support the economics of these things. So it's kind of a flywheel effect. It is, as the prices are projected to go up and as they can lock in these gas contracts at those higher prices, it supports the development. And so as long as the global economy, so this is all predicated on, I think, the global economy continuing to grow, or at least being kind of where it's at today, that all bets are off. If you have a global recession or, economic activity decreasing to where demand is going to decrease, then obviously all about what we're talking about today, you can kind of throw it out the window. But in general, to kind of sum this up, natural gas export capacity has been the primary driver over the past several years. The most significant recent milestone came in December of last year when the Plaquemines liquefied natural gas plant in Louisiana shipped its first cargo. And as of right now, when we hit record, it's up to roughly where its capacity is, which is around 3.6 BCF per day. But that's one of the largest ones in existence. Now there's one in Corpus Christi that's also coming online, and that's like they have these different phases. They achieved first production around that same time period, and as they're scaling up and expanding and commissioning the plant, it's up to around 1.4 billion cubic feet per day. And then Golden Pass is another one, and that one is expected to start up here soon, I think, if it hasn't already. And then that'll continue to ramp up through the beginning of next year. And that has about 2 billion cubic feet per day capacity. So each of these plants is, pretty significant when you think of where we're at from a natural gas production standpoint, supply standpoint. Each of these has a significant impact, say about a 1 to 2% impact on the demand here in the United States for gas. And so as you have that additional demand ratcheting up, that means prices are going to go up as well. So Justin, I think this is it's been a positive story when you look at the LNG export demand. And I think, certainly the fact that we have, Russia not supplying natural gas to Europe, and, Asia doesn't have their own natural gas supplies. And so you see this continual demand that we're looking to supply and take advantage of the arbitrage opportunity between low gas prices here in the US and then what they're paying for it in Europe and in Asia, which in some cases can be up to like 3 times what we get for 1,000 cubic feet of gas here in the U.S.
You said it, Matt. And I think this story really shows how much pent up demand there really was for LNG export. And a big catalyst of this was the previous administration was not supportive of these new LNG terminals coming online. Well, that's no longer the case. And as we can see, it has just been gangbusters for getting these systems online. And it looks like folks have been planning for this. They've been waiting for the veil to be lifted so they could move forward. Matt, we had a question at the convention about energy poverty and the moral sense of fossil fuel, but I think, this says it right here. Liquid natural gas is what is powering our future. It's the cleanest option we have now. It's easy to scale, and for the foreseeable future, it is what people are putting their faith in when it comes to energy.
Yeah, for sure.
So Then the next big thing comes with the data center energy revolution. And so, as we discussed, these data centers are being built at full speed to help serve the AI demand. But with that, they need power. The IEA projects that global electricity consumption from the data centers will more than double by 2030, and that'll make it reach 945 terawatt hours, which is the equivalent to the current electricity consumption of Japan. And AI is a big part of this demand growth. These data centers are being built, and Matt, with this, they're really looking at natural gas as the way to power these, and they're putting them in areas such as Abilene, Texas, where there's a local supply of natural gas that can very easily and quickly make it to the data centers. The other thing is, as we've talked about many times in the past, pipeline capacity there to get the natural gas to market is very constrained, and so it makes for a low-cost option and a win-win where producers can route that natural gas straight to the data centers. They get it for a discount, and the operators do not have to flare that gas. They're able to actually get some value out of that gas.
Yeah, that's a big part of this. I think you see where there is stranded natural gas or excess natural gas. And in my mind, Abilene and part of, West Texas really is a key example of that, because part of this year, natural gas prices at the Waha hub, which is kind of the trading hub for West Texas, they've been negative. So in other words, operators are having to pay to have somebody take away the gas. And so, to the extent that they can lock in a positive price and get some value out of that natural gas, and then it gives these data center companies and operators like Meta, like OpenAI, and others a way to have a reliable source of electricity that they can lock in at a fixed price or a reasonable price to supply the demand that they are going to need to power these data centers. And the thing that's interesting, because artificial intelligence is extremely data energy intensive, and because when they train these models, it uses immense computing power. And this example here, GPT-4, so ChatGPT, if you're familiar with that, by OpenAI, their model, GPT-4, required 30 megawatts of power to train it. And so that's basically feeding all the inputs, having it, run the queries and learn and do all the machine learning stuff that it does, so that when you query it, it can give you a coherent answer. That's a tremendous amount of power. And each of the queries you make on Google, the little preview that's the AI summary of your question that you're asking, or if you ask ChatGPT a question, it uses an incredible amount of power on a per query basis. It's like powering a 60-watt light bulb for an hour kind of a thing. So it's like or 30 minutes or something like that. So it's a significant amount of power for each query. And especially if you're doing that over and over again, that adds up quickly. And so these, when we talk about these data centers, they have extremely high power density. So unlike a normal server farm, that you use for like your Google Docs and things like that, that uses a lot of energy, but it's, if you're storing, documents or files and retrieving those periodically, it's, very small compared to the very energy intensive, computational algorithms that run in these AI models. And so, to talk about this and putting some context, in the United States, data centers are projected to account for about half of the growth in electricity demand through the end of this decade. So, you think about all the things that we use electricity for, half of the demand is going to come from these AI data centers. That's just how much we're talking about. And in Northern Virginia, which is sort of the hub for a lot of these data centers, because that's the sort of the backbone of the internet goes through there. The power demand there alone could rise from about 4 gigawatts today to 15 gigawatts by 2030. And we're talking that's like less than 5 years from now at this point. It's almost quadruple. And in Texas, like Justin mentioned, you have big projects going in Abilene and other places that data centers are looking to make up roughly half of the new power demand there as well, and expected to drive summer grid peaks from 86 gigawatts today to approximately 150 gigawatts by 2030. And you have to supply that additional energy somehow. And they're looking at the easiest way to scale this up and to have the reliability that they need. So the one kind of key constraint with these data centers that prevents you from being able to supply the power through wind and solar and things like that is the reliability. They need to have uptime that's, the 99.99% or whatever, 24/7, 365, these things need to be available. And so what that means is they're turning to natural gas to meet those needs because that is something you can scale up quickly. You can do it in a way that you can get the amount of power generation that you need very quickly because of the energy density of natural gas. And it's reliable, right? It's very consistent. And the demand factors for these natural gas fired power plants, are on the order of 80%. Whereas when you look at wind and solar, we're talking, in the 15 to 20% uptime type of a situation. So there's a big improvement there if you go to natural gas. Now, nuclear is obviously would be the ideal solution. The problem is that it's right now still takes years or decades to develop a new nuclear power plant. Now, someday I imagine a lot of these data centers will be powered by nuclear power through these small modular reactors. But at this point, it's just all very much on paper. There's not really been new nuclear power plants permitted and in progress at this point. So we talk about AI data center demand, it really means natural gas demand. And a lot of that is actually off grid. So where these companies are working with like ExxonMobil and Chevron and these large major oil and gas companies to locate the data centers near where there's natural gas supply and actually have these power plants be off grid. In other words, they're not tied in to supply the nearby homes and businesses with power. It's solely hooked up to the data center. And so that is impressive when you think about the fact that they are going to need that much power to build a full, 600 megawatt power plant or a gigawatt power plant, which is a, large scale type of combined cycle power plant that they would build to supply hundreds of thousands of homes normally. But this is actually looking at potentially being an off-grid situation.
Right, man. Which is, it's interesting that they're going that route. And, data centers, there are some of these projects which they're looking at the power generation as part of the data center project. There are others who are relying on some of the biggest companies to actually generate the power and run those facilities, supplying the energy directly to the data center. But like you said, Matt, they're kind of going about this in whatever way they can to get this energy generation. And that trend towards natural gas-fired generation rather than grid-connected power could be an interesting conversation that's going to come up as they develop this. Who knows what the right solution is there? Maybe both are the right solution. But it's really right now the talk varies so widely because these are intent, these are plans. They are in the process of building the centers, but there's a lot of details to be worked out when it comes to how they're actually going to go about this and the technology they need to create these power stations, so on and so forth. Matt, we'd be remiss to not mention that a lot of these projects are talking about wind and solar as part of the piece of the puzzle. But again, there's not a lot of details quite yet on exactly how they're going to commingle all these energy sources and use them to really power the data centers. And the midstream energy companies report that nearly 60% of the 300 data centers under development in the United States are within 15 miles of an existing natural gas pipeline. And the companies are actively building lateral pipeline connections to serve dedicated data center projects. So with mentioning that, Matt, it makes you wonder if the way that they're thinking about this would be having a dedicated contract with somebody who's supplying them natural gas. However, any surplus would get fed back into the power grid itself. That would make sense. So it'll be interesting to see how this affects our power grids. I think we all know as Americans that our aging power grid is something that desperately needs some updates. I think if anything is going to spur that, not just on the natural gas, but even in the power lines and things like that, this could be a big part of seeing that updated, at least in these regional areas.
Yeah, that's a great point. I think that is going to have to be a big part of this, certainly to the extent that these are connected to the grid. Of course, if they're just tapping into a natural gas pipeline and putting in a power plant that they're just going to use to take power and supply the data center, then maybe that's less of a concern. So that'll mitigate some of those issues that we have with the aging grid and the infrastructure issues. But ultimately, I think some of the numbers that are really interesting, and it really varies pretty widely right now. I've seen numbers from around 2 billion cubic feet per day of new gas demand by 2030 from these data center projects to up to 6 billion cubic feet per day, with upside sometimes projected at being over 10 billion cubic feet per day. So I think the LNG export terminals still are going to be a larger source of that increased demand, but this is almost on the order of those new export terminals when you look at all of the data centers being built. And so those two things combined are very bullish for natural gas. And so if you look at that combined impact on natural gas prices, the Energy Information Administration expects Henry Hub spot price to average $3 per million BTUs for the third quarter of this year. And I think that's kind of right where we are. In fact, it's around 345. And then by the fourth quarter, which actually was kind of where we're at right now, $3.70. And then it's going to be $4.30 in 2026. And some actually are projecting higher prices than that. And Goldman Sachs has set a target for $4.50 per MMBTU for the summer next year. So obviously a lot of things can play into that with natural gas prices. The weather, if it's like a cold winter, the prices will be higher than that. If it's a warm winter, it might be lower than that. But it's, certainly bullish trend when we look at if we have natural gas royalties and if we want to project what that might look like into the future, it's definitely a good time to be a natural gas royalty owner, I think, because you think about particularly in areas where you have a lot of natural gas as the primary thing they're drilling for, like Appalachia and Haynesville, that they're actually going to be able to drill additional wells because the natural gas prices will be high enough that those wells will be economic. And that's always been the challenge. When we look at, we have the demand for natural gas for power generation and all these things, but we've been in kind of an oversupply situation for the last few years. And so these dry gas plays like Haynesville and like the Marcellus, you're not getting a whole lot for the gas, and it's not enough to really support expansion of drilling. And what they're talking about as far as the outlook for natural gas demand, I do think it would support additional drilling for natural gas. And so why the story may not be quite as rosy for oil. I think if you have a mix of royalties, if oil's down right now, it's just barely above $60 per barrel, but natural gas is on the rise. And so in that case, if you have areas that are in a good part of the Haynesville, the Marcellus, that maybe hasn't been drilled yet, pay attention to what the operators' plans are in those areas, because it could mean that there are going to be additional permits and additional wells drilled in your area. And so I think ultimately to support all of this, though, we need the infrastructure to be able to take the gas from where it's produced to where it's used. In this case, whether that's a data center or an LNG terminal. So we see midstream infrastructure and new pipelines needing to be built to support a lot of this as well, especially if they're needing to take it from the normal distribution pipeline to build the data center. Now it's less of an issue if they build the data center right next to the gas field, because they can just build a short pipeline there and connect it up and it'll be fine. But, interesting when you think about those potential constraints and how this all can play out. And obviously we're simplifying a lot of this here, but it definitely is a positive outlook.
Yeah, you said it, Matt. They kind of have an option, and I'll be really curious to see how the cost difference of going directly to the operator and working with them for shorter runs of pipelines directly to the data center versus building midstream infrastructure. I'm sure that'll kind of tell the story of which they end up heading towards. And if the data center is not located close to that production, then midstream is going to be the name of the game, which we've needed that for a long time anyways. So Matt, like you said, for people in, gas rich places, this is a wonderful thing. And then for folks in the West Texas, this can really alleviate this pipeline takeaway issue and help to go towards less flaring as well, which is always a good thing.
Yeah. And I think if you can, hold out for those prices to recover, certainly if you have natural gas royalties, it would be something that I would expect to see more activity there. And I think the EIA here, there's a quote that it says it expects drilling to activity be more centered around natural gas intensive producing regions in 2026 as the premium of crude oil over natural gas narrows to its lowest level since 2005. So, it's good if you have a mix of commodities and you think about if you get royalties from crude oil production as well as natural gas. Well, if oil prices are down but then natural gas is up, it should help hopefully level things out to a certain extent. But, I think the big thing when you look at, okay, let's talk about some of those challenges and uncertainties that could throw a wrench in all of this. So first of all, I think that we look at projects under constructions that are actually going to get completed on schedule. So that's the big risk with these LNG projects is they're very massive projects that can be faced with challenges, whether that's finding funding, getting that final investment decision and actually going from a proposed project to something that's under construction and then gets commissioned and built, and bankruptcies of companies along the way, and does that throw a risk that they actually get completed. The other thing is we're not the only supplier of liquefied natural gas globally. Qatar is also pursuing massive expansion plans that will supply additional liquefied natural gas to the market. And then also if we have tariffs that, it costs more for a cargo from the US versus Qatar or other places like that, especially going to places like China where we have a little bit of a trade war going on, that could cause, while we have the demand or the capacity for those terminals, obviously we have to be able to have the contract to sell those cargoes and have somebody buy it on the other end. And, it's all run on economics. And if tariffs make it more expensive, that could be an issue. And then I think the other thing is we see AI, and I kind of feel like we're a little bit in this bubble situation. So I don't know, for those of you that were around the Y2K and like the whole .com bubble that happened in the early 2000s, it feels somewhat similar where you have these valuations of these AI companies that are through the roof. Like OpenAI, I think was valued at around $500 billion, but they only made like $3 billion or maybe even had a little bit of a loss last year. So it's hard to justify those valuations. And so in my mind, if they face some headwinds from investors and their stock prices plummet, and does that mean there's less money to invest in these projects? It might dampen some of that demand growth. So there is a risk there, I think, when you look at it from that standpoint. But what do you think, Justin, from like looking at the bigger picture? What are some of the other issues you see?
One of the things that I noticed, and I was doing some reading about the data centers and what they're building, these companies want to talk about renewables. And that is how they're going to speak about it. For instance, in the Abilene area, one of the issues that they're currently talking about is that they picked this area because of the wind generation, which certainly is true. However, it's not really the reality on the ground right now. It doesn't supply enough of the power needed for consumption, but it'll be interesting to see as we move forward, are these companies going to dump a ton of money into green technologies and developing those? Are they going to, start with natural gas and work on developing there? Another interesting thing to remember about technology in general is this is kind of a benchmark of where we are as far as efficiency of these systems. But all of this demand could change as systems become more efficient, as they require less power generation. And we know that that is something that's going to happen as the technologies improve. So that'll be an interesting thing to see and see how that changes the projections. But Matt, the amount of increase right now that they're estimating is really mind-boggling. Projections for 2030 range, as you mentioned, from 1.3 billion cubic feet per day to a high of 16 billion cubic feet per day. And that is just a massive range. So right now, the data centers are moving at lightning speed. They're looking at multiple locations simultaneously and then making rapid changes to project scopes. Some are publicly announced, which are some that we've talked about, and a lot of them are confidential at this point. So it'll be interesting to see how this develops over the next year or two. And then, Matt, last but not least, political headwinds. Right now the administration is very favorable for this, and I think that's part of the reason they're moving so quickly. But in coming years, it'll be interesting to see what administrations decide to do on this, and that could very much change the direction on how these data centers are powering themselves, or at least what they're putting investment into.
Yeah, that's a great point. If there is significant concern over climate change to where these need to be net zero, does that kill the economics? Maybe there is the desire to build them, and natural gas seems like the most logical choice from a scalability standpoint. But did they say, well, no, we need to build a nuclear power plant and it's going to take 5 years to do that instead of 2 years? That could extend out these projections into the future and not mean that they wouldn't happen as rapidly as maybe they're being projected right now. Or do they need to put carbon capture in? I think that was the other thing that you mentioned. I know when we were talking about this, Justin, is that companies are looking at. How do we maintain our desire to be green or desire to be carbon neutral with the realities of what we need to supply the electricity for these? And it, right now it means likely natural gas. And so do they look at sequestering natural gas or CO2 emissions as part of this whole thing? And, how does that affect the economics and the timing and all of those things? So lots of uncertainty, but, I think the winds of change are blowing, and it's certainly not going to be blowing a wind turbine. It does look like it's going to be fueling the demand for these data centers by natural gas. And then I think ultimately nuclear power, but I think we're still maybe decades away from that being a very quickly scalable source of electricity. So pretty interesting when you look at it. I think ultimately, when we boil this down, like I said earlier, from a mineral and royalty owner perspective, it's a good time to own natural gas royalties. I do think it's going to be a good year next year for natural gas, and maybe challenging, continue to be challenging for oil. But we'll just have to see what happens. So thanks again for listening. And again, we'll have all links to all these resources and sources that we mentioned in the show notes, which you can find at mineralrightspodcast.com. Thanks again for listening. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.